Australian interest rates are actually higher than the US, New Zealand, Canada, and other countries. Wait, what? You're probably thinking, no, PK, that's not true. The US has higher interest rates than us. New Zealand has higher interest rates than us. Which, just bear with me. In this episode, I'll actually prove to you how Australia has higher interest rates than our peers, why I'm seeing a divergence between the Australian and the US economy and its implications, whether we're going to go into a recession. And at the end, I'll take us through what it means for house prices if interest rates go up again and if they go down. And it might surprise you, especially when we go at the city by city level. Lots to cover, lots of data, lots of charts. Really excited. Let's do it. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. In this channel, we expose the reality, the truth about the Australian economy, property, and financial happiness. Hit the subscribe button, give it a like, at least do that for me. That's awesome. Thank you. Let's start here. Outstanding mortgage rates on a weighted average basis. Now this shows Australia versus US and other countries, actually shows how Australia has a mortgage rate of 6%, which is higher now than New Zealand, way higher than the US at under 4%, higher than the UK. So how does this make sense? Well, of course, New Zealand, the US have higher official cash rates, but let's take the US for example. A lot of its loans are on 30-year fixed mortgages. So that means when interest rates go up, a lot of people, maybe even most people, don't actually feel that because they're not on a variable rate. Now, of course, in Australia, we don't have 30-year fixed mortgages. Therefore, the impact of swings in the interest rate actually affects homeowners, mortgage holders more variably. So if you combine the amount of people who've been actually impacted by the interest rate rises in the last couple of years, you actually find that Australians have been impacted more than many other countries. And therefore, for mortgage holders in Australia, they're actually paying a higher interest rate than the US. Not many people know this, and we just go on about headline figures coming out of the news. But if you delve a bit deeper, then this tells me that we're unlikely to need to catch up to the official cash rate of the US to really slam down inflation. Now, this is not an interest rate projection, but I'm giving you some insights here. And this is then further substantiated when you look at household disposable income per capita, real disposable income per capita, all right? And you see in the US, it's going it went up in 2022, 2023, now stabilizing. Same with OECD countries, same with G7 countries. But in Australia, this blue or purple line is trending down, 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 down. People here in Australia are doing it much worse than what we think our peers are doing overseas. Household consumption in Australia, it's in the negative in 2022, in 2023, now at the start of 2024. Whereas if you compare that to the US in the red, every quarter household consumption is actually going up. The rate of increase is positive. Once again, versus the US, we're chalk and cheese. Look at this, change in debt service ratios, as well as talking about before, shown in a different way. Australia's debt serviceability has shot through the roof, so much indebtedness compared to Canada, US, UK, Germany, and South Korea. Each economy is different, and we appear to be vastly different from a lot of our peers. We can't just say that our interest rates need to match the US for inflation to be subdued. Now, this doesn't mean that we need to all of a sudden slash interest rates in Australia this year, but they definitely are coming down. The OECD reports that inflation has peaked but remains high. You can see it's going down in basically every country around the world. The recent murmurings over the last few weeks is that it hasn't gone down as much as expected, especially in Australia and the US. But that doesn't mean it's not going down, okay? There's a clear difference. It's still going down, but just not as fast as we expected. And because monetary policy remains tight, growth is projected to slow further, bringing inflation back down. For Australia, the OECD predicts real GDP growth in 2024 to be 1.3%, then going up to 1.8% in 2025, avoiding a recession. In terms of inflation, or CPI, expects 3.3% in 2024, going down to 2.8% 2.8% in 2025. So inflation is here to stay, but it is coming between our band in 2025, according to the OECD. So before we get all flustered of how inflation and interest rates may be going up, just take some stock to understand this in perspective. Inflation's coming down, interest rates are unlikely to come down anytime soon, but both things are likely to come down in the next year or two, and we're different from the US. Our economy is not as buoyant, therefore the upside risk to interest rates is much more subdued than overseas. But PK, there's still a possibility of Australian interest rates going up again, 0.25%, 0.5%, etc. What do you say to that? Look, granted, I'm not going to say there's no chance of interest rates rising, but let's now analyze what that could mean for the housing market. Let's start here. Australia to fall 300,000 homes short of Albanese's target. Reported by the AFR, Labor's target of 1.2 million new homes in the next 5 years has been shot down by its hand-picked National Council, the one that the government created, which forecasts a shortfall of nearly 300,000. Okay, that's like over 30% of the target, aggravating existing shortages and affordability problems. So everyone knows we're in a housing shortage. What will interest rate rises, doom and gloom, right, due to that shortage? Well, this same National Affordability and Housing Council formed by the government is basically insinuating to the government, please central banks, don't increase interest rates. Independent Housing Report urges RBA to heed advice on interest rates. This is what the Real Estate Institute of Australia has to say about the government's own council. Of relevance ahead of the Reserve Bank's meeting this week, the one that's just gone, is the abhorrent impact of interest rates on housing supply, the root of the current housing crisis. The council said a decline in interest rates of 50 basis points, or 0.5%, would boost net housing supply by 54,000 dwellings. And a rise, okay, this is our question, a rise of 50 basis points, or 0.5%, would decrease the net supply by 45,000 dwellings. We hope the RBA heeds this warning shot issued by the government's own independent housing advisor. What this is basically saying is every time interest rates rise, people borrow less, right? They don't have enough borrowing capacity, it shrinks. Therefore, their demand for brand new housing shrinks as well, which in turn flows through to new houses coming out of the ground. And also, to couple this, the construction companies, the building companies, you know, all the ones that are going bankrupt, they have even more cash flow issues. They can't fund their own inventories. They can't fund their own businesses. They have cash flow issues and they go bust. It's super counterintuitive. Every time interest rates go up, we have a bigger housing shortage because of these two reasons. Therefore, house prices go higher even more. And of course, if interest rates come down, people have more demand and house prices go up. So hang on a second. Interest rates go up or down, house prices go up. Of course, I'd say that, right? Being in the property industry. But let me know if you disagree in the comments. This is what the government's own agency is saying. Basically against the political narrative that Albanese wants to try to put out in time for the next election. And so what that means is you have basically every single political commentator, economic commentator, and property commentator saying that house prices will rise in the next 1, 2, 3 years in Australia and beyond, despite what happens to interest rates. Probably the only exception is Martin North. Hi, Marty. So here's Matusik, one such commentator, who's given his forecast of median detached houses. So he's saying right now, as of March 2024, so a couple of months old, these are the current prices. The average capitals are about 9-10,000. And by March 2025, so in about a year from now, the percentage increase will be in Sydney between 5 and 7%, in Melbourne between 0 and 2%, in Brisbane 2 to 5%, Adelaide 5 to 7%, Perth 7 to 10%, Canberra 0 to 2%, Hobart -2 to 2%, and Darwin 0 to 2%. Overall, the capital city index will rise by 2 to 4%. Not huge, right? Not huge. But remember, households are struggling. Our serviceability ratios gone. We have the highest effective weighted average interest rate for mortgage holders in the world amongst developed countries. There's a cost of living crisis, inflation is high. Despite all of that, because of the logic that I've walked you through today, house prices are still going to rise. Of course, not by the traditional 6 to 7% long-term average, but markets within markets. See here, Perth, 7 to 10%. That's beyond long-term average. Adelaide, 5 to 7%. And of course, regional centres, especially regional Queensland, regional South Australia. I'm even seeing a bit of sparks in regional New South Wales. And I think my clients will start to buy in regional Victoria very soon, just monitoring the data. Regionals are actually outperforming capital cities in the last 12 months. Remember how people said that was only a COVID phenomenon? Everyone leaving capital cities to get out into nature, working from home. Now they'll have to come back to capital cities. Regionals don't grow. Well, over the last 40 years, regionals have grown just as much as capital cities, and that trend continues despite companies calling back their workers to the office. And for those of you who aren't gazillionaires, I want to give you a tip before I finish this episode. Check this out. Detached house prices in bands. So back in 2020, 25% of all detached houses were under 500,000. Okay, now it's just 9%. Back in 2020, 32% of all detached houses were between 500,000 to 750,000. Now that's reduced to 29%. What this is showing is that the growth in the last number of years has really been towards the more affordable end of the market. And if you're watching this or listening to this right now and you're like, I want to become a property investor, or I just want to buy my own home, and your budget is less than $500,000, then this is not financial advice, but it's hard to see a day 5 years from now or 10 years from now where this 9% under 500K remains 9%. My prediction is that 9% as a proportion of total dwellings will drop to well under 5, 4, or even 3%. So if your budget is under 500K, my friends, don't wait, you're gonna miss out. So hopefully you now understand how we're different from the US in terms of our monetary policy and economy. Yes, when the US sneezes, we also get the cold, but it's more nuanced than that. And I don't think we're in for many more, if any, interest rate rises. But even if it does happen, house prices bought well, as demonstrated, will continue to rise. Get in now, because especially those cheaper properties aren't going to be there for much longer. And we're already seeing that in places like Perth, where under 500K is basically almost a thing of history. For those of you who can see the light despite all the uncertainty and actually want to use this opportunity to get ahead, I'll leave links below to my podcast, Oz Property Mastery, on Spotify, Google, or iTunes, where you can level up your knowledge, and also my Facebook group with 50,000 amazing people, Australian Property Mastery with PK. Learn, grow, and succeed. That's what I want you to do. Hit the subscribe button, give it a like, and I'll see you next time. See you guys.